On July 3, 2026, the price of gold did something it had never done in 4,000 years of human history. It closed above $4,100 an ounce. 4,122. To be exact, the headlines blamed a weak American jobs report. They blamed nervous investors. But that is not the real story. Because the biggest buyers of gold right now are not people. They are governments. And one government in particular has been quietly trading away its pile of American debt for a mountain of gold. This is the story of the biggest shift in the world's money in 50 years. Told in tons. To understand what is happening, forget the daily price for a moment and look at who is buying. For most of the last 30 years, central banks were net sellers of gold. They saw it as a relic, a shiny rock that paid no interest, cost money to store, and did nothing but sit in a vault. Their real reserves were dollars, and specifically, United States government bonds, which paid interest and could be sold in seconds. Then, around 2022, something snapped. For 3 straight years, central banks bought more than 1,000 tons of gold every single year. To put that in perspective, that is roughly double the pace of the entire previous decade, when annual buying averaged 400 to 500 tons. In 2024 alone, gold's price jumped 26%. And then the truly historic milestone arrived. In 2024, gold quietly overtook the euro to become the world's second largest reserve asset. Think about that. The single currency of a 500 million person economic bloc was pushed into third place by a metal. According to the European Central Bank's own analysis, gold now makes up about 20% of global official reserves. The euro, 16%. The US dollar still leads at 47%. But its crown is slipping. The total gold held by the world's central banks has climbed back toward 36,000 tons. Close to the all-time peak of about 38,000 tons last seen in the mid-1960s. At the height of the gold standard, let that sink in, after half a century of governments slowly selling gold and trusting paper currencies instead. They are now hoarding almost as much metal as they did back when the dollar itself was still legally backed by gold. This is not a small tweak at the edges of the financial system. It is a reversal of a 50-year trend. And it is happening in the space of just a few years. Who is driving it matters too. The buying is overwhelmingly led by emerging economies. And above all by Asia. While the developed West mostly sits still, the world's official money is, slowly and deliberately, turning back into metal. Now, no single country tells this story better than China. China's central bank, the People's Bank of China, has been on a buying spree that is remarkable not for its speed, but for its stubbornness. As of mid-2026, it had bought gold for 19 months in a row. That is the longest continuous buying streak since the bank began publishing standardized monthly figures back in 2015. It did not stop when prices were low. It did not stop when prices hit record highs. It just kept buying, month after month. Its official gold holdings have now climbed to around 2,322 tons. But here is the part that makes economists sit up. While China was buying all that gold, it was doing the exact opposite with American debt. At its peak in 2013, China held more than $1.3 trillion in US Treasury bonds. It was, effectively, one of America's biggest lenders. By February 2026, that pile had shrunk to about $693 billion. The lowest level since the 2008 financial crisis. That is a decline of roughly 50% from the peak. Read those two trends together and the strategy becomes impossible to miss. Sell the paper promises of another government. Buy the metal you can hold in your own vault. Gold up, US debt down. This is not a coincidence. And it is not opportunistic bargain hunting. Analysts describe it as a strategic mandate. A deliberate, long-term rebalancing of what China considers safe. So the obvious question is why? Why would the world's central banks, the most conservative money managers on earth, suddenly fall back in love with a metal that pays no interest? The answer can be traced to a single moment. February 2022, when Russia invaded Ukraine, Western governments did something that had rarely been done to a major economy. They froze roughly $300 billion of Russia's central bank reserves. In an instant, money that Moscow thought it owned, sitting in accounts in New York, London and Frankfurt, simply became unusable, and every finance minister on the planet learned the same lesson at the same time. Dollars and treasury bonds are not really your money. They are a promise from another government. A promise that can be switched off. Gold is different. Gold sits in your own vault. Inside your own borders. It has no counterparty, no issuer, and no off switch. Nobody can freeze a bar of gold in Beijing from an office in Washington. This is the heart of what people call de-dollarization. It is not that countries suddenly hate the dollar, or that the dollar is about to collapse tomorrow. It is a slow, defensive hedge against a very specific fear. The fear that in a world of sanctions and geopolitical rivalry, your reserve currency can be turned into a weapon aimed at you. And the deeper irony is this: the more the dollar is used as a tool of foreign policy, the stronger the incentive for rivals to hold less of it. Every sanction, in a sense, is also an advertisement for gold. There is a mechanical layer to this fear as well. Dollar reserves do not really sit as physical cash. They live as entries in the global banking network, cleared through systems that ultimately run under American and European jurisdiction. Freeze the entries, and the money is gone without a single truck ever moving. Gold answers that vulnerability in the most old-fashioned way possible. It is a physical bar, weighed and stamped, sitting on a shelf you control. That is also why China has spent years quietly building its own gold vaults and encouraging refining and trading at home, rather than storing its metal abroad in London or New York the way many countries traditionally did. If the whole point is to escape someone else's off switch, you do not hand them the keys to your vault. Sovereignty, in the end, is the product being bought here, and gold is simply the cleanest way to buy it. This creates a powerful feedback loop, and it is exactly what pushed gold to that record price in July 2026. Here is how the machine works. Central banks buy gold to reduce their reliance on the dollar. That steady, price-insensitive buying puts a floor under the market. It absorbs supply that used to go to jewelers and investors. When a fresh shock arrives, like a disappointing US jobs report or renewed tension in the Middle East, private investors pile in on top of that floor. And because central banks are not selling into the rally the way they might have 20 years ago, the price has nowhere to go but up. That is why gold has more than doubled in just a few years, tearing through $3,000, and then $4,000 an ounce. But zoom out and the consequences are much bigger than a price chart. Every dollar that a central bank moves out of US Treasuries is one less dollar helping to finance America's enormous national debt. For decades, reliable foreign demand for treasuries helped keep US borrowing costs low. If the largest holders keep stepping back, that job falls to someone else, and often at a higher interest rate. At the same time, a world where gold, not just the dollar, anchors reserves is a more multipolar world. It is one where no single country's currency can dominate quite as completely as the dollar has since 1945. We are not watching the death of the dollar. We are watching the slow end of its monopoly. So where does this go from here? It is tempting to imagine central banks buying gold forever. But the data adds important nuance. In 2025, total central bank buying actually cooled to around 863 tons. Still enormous by historical standards, but below the 1,000-plus ton pace of the 3 previous years. The reason is simple. Even central banks flinch at record prices. As gold rocketed higher, some buyers turned cautious, proving they are not completely blind to cost. And yet, the structural story points in one direction. Consider this: gold still makes up less than 9% of China's total reserves. Compare that to the United States, Germany, or Italy, where gold can account for 60 to 70% of reserves. If China simply wanted to match the typical allocation of a major economy, it would have to buy gold for years, possibly decades, to come, and China is far from alone. In 2025, the National Bank of Poland was actually the single largest buyer, adding 102 tons. India's central bank bought 18 tons in just 1 month in early 2026, pushing its holdings past 820 tons. Turkey, and much of the emerging world, are on the same path. And notice the pattern in that list. Poland, on the eastern flank of NATO, staring at Russia, India, balancing between East and West. Turkey, straddling both. China, the great strategic rival of the United States. These are not random gold bugs. They are precisely the countries with the strongest reasons to worry about being cut off from the dollar system one day. Their gold buying is a map of the world's geopolitical fault lines. Drawn in bullion, there is one more force underneath it all. For years, the world produced more debt, more deficits, and more printed money than ever before, while the amount of gold in the ground grew only slowly. When the supply of paper claims explodes and the supply of the hard asset barely moves, the price of that hard asset, measured in paper, tends to go in one direction over time. So the next time you see a headline screaming about the gold price and a scary jobs number, remember what is really underneath it. A quiet, deliberate, multi-year decision by the world's governments, led from Asia, to trust metal a little more, and each other's paper a little less. That is not a trade. It is a message. If this breakdown helped the numbers make sense, subscribe to Asia by the Numbers for a new data story every day.